benchmark indices recover from opening lows to trade near the flat line. The Nifty trades around the 25,300 odd mark, aided by metals, realty as well as financials. On the other hand, the tech space emerges as the top sectorial loser. The broader market trades in line with the key indices.
Shares of IT stocks trade under pressure and are the top losers on the Nifty after the Trump administration raises H-1B visa application fees to $100,000. TCS, Infosys, Tega, amongst others, take a hit.
Consumption stocks rally as the new GST era gets underway. India Inc. also sounds optimistic. Bajaj Auto is expecting a strong festive season. Shoe retailer Metro Brands also expects good strong growth at around 15% CAGR post this GST rate cut.
And shipbuilders and focus today. Garden Reach Shipbuilders rallies on a $62 million order. L&T, Mazagon Docks and Cochin Shipyard also trade with gains on reports of an 80,000 crore tender from the Indian Navy coming soon.
NetWeb Technologies rallies 5%. This after it backs a 450 crore rupee order from Tyrone AI GPU systems. Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, and with me today is Ekta. Hey Ekta, good to have you on the show. Well, the market started off in the red, but a good recovery is what we've seen from the low point of the day. And this keeping in mind that the tech space is actually under pressure. So pretty heartening start actually to trade today.
Hi, Nigel. Yes, absolutely. You know, if you just pull up the Nifty IT index on an intraday basis, there has been a recovery which has taken place there as well. So around 1% in terms of a recovery from the day's low for the Nifty IT index. And we have the Nifty, which is at around 25,317. So not as bad because we now do have the mid-cap index, which is just about broken into the green as well. So overall, the market seems to be a little more sanguine in terms of all of the bad news that took place over the weekend with regards to the H-1B visas. And separately, we do have the GST rationalization or GST 2.0, which really kicks in from today. So that's the other big trigger to watch out for.
Well, that's right. Let's move to our first corporate conversation then. Mr. Mehul Monka, the Managing Director and the Group CEO of Tega Industries, joins us on the show. Hi, Mr. Monka. Thanks a lot for joining in. Well, we're coming across to you post the announcement with regard to all those that will be participating in your fundraise. We're coming to you in just a bit. For the time being, just highlighting the three broad focal points we're looking at: funding structure for Molycorp acquisition, the plans for unlocking synergies, and growth and capex plans for Molycorp as well as Tega. Mr. Monka, thanks a lot for joining in. Well, let's get a couple of details first out of the way. With regard to the company, this acquisition turning EPS accretive, you had mentioned it'll turn EPS accretive in the second or the third year. So will it turn EPS accretive in FY27 or is it a plan for FY28?
Morning, Nigel. Thank you for having me on the show. It's going to be EPS accretive from FY27 onwards.
Okay, all right. Got that clarity out of the way. Well, Mr. Monka, I'm not too sure about this data point, but I think this could be one of the largest fundraisers, via the preference route, could be in the top 5 as well, if you have some clarity on that front. And also tell us, what is the feedback you've got from your shareholders? Because you're looking to buy a big asset, but there are some that are a little bit nervous with regard to this sort of, of being so adventurous. Your feedback?
Yeah, so on the fundraise, I'm told that it's the largest in Indian capital markets through the preferential route. I don't have data points to confirm that, but that's what I've been told. I do understand, the shareholder, I would say, caution, but I would say that, we ourselves are looking at it, from an optimistic caution perspective, as one would say. We're excited about the opportunity. I think it builds great value for both the businesses put together. They're complementary in nature. And end of the day, we bring a lot of value to our customers globally.
Okay. So, Mr. Monka, just for your shareholders, if you could just reiterate how exactly would you be funding the acquisition? Because you have this preferential issue of around 2,000 odd crores. I understand that you have to, you will be funding via internal accruals as well. Can you just take us through the breakup of the funding of the acquisition?
Sure. So, from Tega's perspective, we need 3,300 crores in total to fund our 77% equity participation. We have 1,000 crores in terms of corporate debt already lined up as far as Tega is concerned. And we are to raise 2,300 in terms of equity raise for Tega, of which 2,000 we have confirmed participation as of now. And we're going to be doing another 300 crores of fundraise shortly.
This 300 crores will be to who?
We are going to do another fundraise of 300 crores.
So just break up this 300 crores. What kind of fundraise are you looking at? And by when? What is the timeline?
I think 300 is too small a chunk to do in QIP. So we'll probably do another preferential raise. We have to meet. Sorry, we'll do it as soon as we complete the first one as per stock exchange guidelines.
Okay, got it. All right. And who is it going to be to?
We have a lot of interest currently already with a few institutions who missed out on the first one. So there still remains a few who are very excited about this transaction. So we will bring them in.
So expand a little bit on that in terms of the kind of interest that you've seen from what was the profile of the investors, and even for this incremental 300 crores who didn't get to participate and is looking to participate. Just take us through the details.
These are domestic institutions. I don't think I can reveal the names at this point, but we are in discussions as we speak. And there remains to be a strong interest to participate in the next round.
Well, that's right, Mr. Mohanka. I have my ear to the ground as well. And I believe that there was some strong interest. And some of those names didn't appear in the first list. So let's see whether or not they get into the second list. Got that. Now, let's focus on the business that you're taking over. One of the measures of cost saving is going to be relocation of the headquarters. Have you identified where's that headquarter going to be? And I think what you've guided for is around $7 million of savings. So tell us more.
Sure. So that's going to be somewhere in Asia. We haven't narrowed down on the exact city, but we are in discussions with the management team of Molycop for a particular location. It has to be, something favorable from a time zone perspective because it's a global business, as well as, what we're attempting to do is find a city where there's, we can find one flight to anywhere in the world. So yeah, that process is on, and I will confirm that shortly when we get to it.
Okay. You are expecting to unlock EBITDA level synergies of around $20 million by year 2 and $30 million per annum from year 4 onwards. Just tell us about this particular synergies. Where are you looking at in terms of synergies, and what would this mean in terms of consolidated blended margins for you all?
Sure. So these synergies are going to flow through from incremental revenue at Tega level as well as at Molycop level. So we have customers out in the marketplace who will benefit from participation from both the companies in the operational efficiency of the customer. So we're looking at these incremental cash flows to come through, or revenues to come through in both balance sheets of Molycop and Tega. And we're looking at close to about, I would say, in total, anywhere between $80 to $100 million of incremental cash flow to come through in the books of both the businesses to pay down debt.
Okay. All right. Final question then before we let you go, Mr. Mohanka. You're looking at increasing capacity on the high chrome side as well. And there has been that move from forged media to high chrome. Now, you're looking at increasing capacity. I think currently you're doing 20,000 and then 40,000 traded, so it's around 60,000, which you're looking to around 200,000. We have a peer that's listed, AIA, and they have said that, they find that they've seen some headwinds in this sort of a move, particularly on high chrome. What is your comment on that? How confident are you that you'll be able to achieve the guidance that you've given on this segment?
Well, I'm unable to comment on the views of my peers, but from our perspective, the way we're looking at it, I think there's been a lot of commentary that high chrome is gaining against forged media, but we don't believe that to be true. For us, we're coming out of a very small base. There are peers who are larger in the high chrome space globally compared to Molycop, but we are fairly convinced that high chrome is a good space to be in, and coming off a low base, I think the CAGR we're looking at about 15 to 20% over the next 3 years is much doable.
Execution will be key then on that front, because as I said, it's been a challenge for some of your peers said. Final question, your revenue in the last year was around 1,600 crores approximately. Now, going by what all you have said, do you think the EBITDA number can nearly be double of your revenue, say in the next 4 years from now? Mathematically, it looks like the EBITDA number will be in excess of around 3,000 crores. Possible?
Absolutely. That's the reason why we're bringing these two businesses together.
Okay, just before we let you go, just a quick question with regards to the eventual debt that you would be comfortable comfortable with on Molycorp's books, because you're saying that you have $1 billion, you'll go to 780 million from day one itself. But eventually, what's a comfort level that we're looking for in terms of the debt on Molycorp's books?
So we won't like it to be anywhere higher than two times EBITDA at any given level. So the idea would be over the next 4 years to pare it down to those levels.
Okay, so at any given point in time, it shouldn't be more than 2 times EBITDA.
That will be the aim.
Okay, all right. We're going to leave it on that note. Thanks very much for joining in and speaking with us. So that is Tega Industries talking about their preferential issue of around 2,000 odd crores. They are planning a second preferential issue of around 300 odd crores, saying that interest has been quite significant there. We'll take a short break. We'll be talking to Ankur Rudra of JP Morgan from the JP Morgan 10th Annual India Conference. Stay tuned for that. Welcome back. You're still tuned into Chartbusters on CNBC-TV18. Well, we now have Ankur Rudra, who's the head APAC Telecom and India TMT Research at JP Morgan, joining in to discuss his outlook on the IT space. Ankur, hi, welcome to the show. Well, I'm sure it was an extremely busy weekend for you, and you're probably working the phones throughout. So what is your sense in terms of, all the news with regards to H1B and even the clarification and net, the impact, according to you, on, say, frontline IT stocks?
Hi, thank you. Thank you for having me. So it's been, I think, the proclamation clearly on an overall basis prices out H1B visas as a source of labor for the industry on a prospective basis. I think what's been helpful is that it's been clarified it applies only prospectively, and it's a one-time charge. So I think what we think is likely to happen is a lot of the enterprises and which outsource, and also the vendors themselves, will relook at their sourcing strategies to see if they can change the labor source. Increasingly, they've been depending on H1B visas less and less over the last 5-6 years. If they can further move towards local hiring, if they can also start using a lot more of nearshoring and offshoring. So we think that will happen to an extent to dilute the impact on a going forward basis. In terms of impact, it's very early days. Typically, when we have new changes, there are always some kind of litigation lawsuits against it. So there is some time for this to potentially impact. It's likely to impact the lottery year from next year onwards. But we think that across the board, around 20 to 50% of on-site employees for IT companies are probably impacted, and about 2 to 6% of earnings impact on an annualized basis from F27 to F30. But that's the worst case. We don't think the worst case will happen. Companies will change sourcing strategies.
All right, Ankur, good to have you on the show. The worst case unlikely to play out, and that's the hope. But, the tech space itself has underperformed, in the last 12 months or so, and gradually it was beginning to find favor yet again. Now, what's your view on the sector itself? Because growth could still remain very, very tepid. However, if you look at valuations, if you look at cash flow yields as well, they seem to be, turning a little bit favorable. So how are you placed?
Yes. So I think if you look at the overall IT services sector, there has been two sources of challenges. One is the macro, which has not been helpful thanks to the tariff and the trade uncertainty. which has been impacting demand. And second is potential deflation from an AI perspective, which is probably more medium term. In the short term, we would expect that the macro sort of headwind potentially eases away from calendar year 26 onwards. So this year is likely to be a weak year in any case. But the AI deflation probably plays out maybe for a 2 to 3 year base period and sort of goes away from the base. So when we look at the sector, we look at it in two angles. One is among the larger firms, which have become a lot more value, like you said. Free cash flow yields and dividend yields have become the cheapest they've been in the last 8 to 10 years, which provides a lot more value in sections of the large cap space which do pay out dividends. And on the mid cap side, there's some companies which are growing a lot faster where these headwinds don't play out so much. So our approach is to have the value large caps which pay out dividends, which look attractive now, and some of the growth oriented mid-sized companies which can grow meaningfully faster from here on.
Ankur, Q1 actually stood out because there was some amount of revenue and margin deflation. As we get into Q2 and, just a couple of days before the quarter ends, what's your sense in terms of the trend that we could expect? Do you expect that sort of trend to continue into Q2?
Yeah, I think there are a couple of things here. One, overall demand environment probably will remain unchanged in the sense that we will not see any further worsening or any meaningful improvement in the demand scenario. But from a bottom-up perspective, I think when we came into Q1, there was an element of negative surprise that demand was as weak as it was. I think in Q2, that negative surprise is unlikely to be there. And there's been a lot of larger contracts which have been signed on a cost-saving basis by a number of companies in the last 6-9 months. Some of them probably begin to ramp up. So we probably will see bottoming out of demand and growth being a bit more stable from here on. I don't expect things to meaningfully worsen. Having said all of that, signings might get impacted to an extent because of the visa-related uncertainty, but that will be more of a medium-term thing. From a revenue perspective, we think it will probably be similar to what we saw in 1Q, if not slightly better.
Okay, Ankur, just turning attention a little bit away from tech, a quick comment on telecom. Do you think that it's going to be a 3-player market? And what are the ARPU increases you're working with? 26, 27?
Sure. So on the telecom side, we think that remains a 2.5-player market where the top 2 companies have invested very meaningfully and hence keep taking share to an extent. The third player is something that the government has indicated multiple times they want to do. So we'll have to see how that plays out. It will be a function of the solution on the AGR front. It's difficult to say at the moment. But our medium-term assumption is we'll have all the 3 players there. There'll probably be some sort of a solution. From an ARPU perspective, we have assumed a 10 to 15% kind of a tariff increase for the next couple of years, so around 10-ish% for fiscal 26 and around 10 to 15% for fiscal 27. So the change in view is earlier we had every 2 years there would be a tariff increase. Maybe now we might have a smaller tariff increase on an annual basis. That's what we baked in.
Okay, all right, Ankur, a short but effective chat. Wishing you all the best for the remainder of the conference and looking forward to chatting up with you as things do progress. Well, time to slip into a short break. On the other side, we'll focus more on markets as well as on stock-specific action. Stay with us.
Welcome back. You're still tuned in to Chartbusters on CNBC-TV18. Well, as you can see on your screen, it is a good recovery that we've seen for our markets. We have the Nifty, which is just about flattened out. We have the Nifty Bank, which is holding up with a gain of around 0.2%. And like we've been pointing out, there has been some recovery which has taken place for the IT index as well. So it seems as though the markets are quite sanguine in terms of all of the bad news which has taken place over the weekend. But as you can see, the IT index is still under pressure, down around 2.8%. We have Infosys, TCS, HCLTech, all of these frontline stocks which are under pressure today. But nonetheless, good recovery, Nigel, you'd have to say.
Well, that's right. The market's almost in the green. That's the Nifty, mid-cap index, even Stevens. Nifty Bank put its hand up and getting counted, while the tech space, we'll have to see what kind of a recovery we can see from these levels. But to be fair, from the lows of the day, it's recovered close to around 0.7%. We'll wrap up on this edition of Chartbusters. You stay with us. The team of Trading Hour is waiting by.